Hello, everyone. My name is Giovanni Nogales, and I'm a paralegal here at Lyles Parker. Welcome to today's webinar hosted by the Texas Association for Home Care and Hospice. Just a quick reminder, if you have any questions throughout the presentation, please feel free to type them in the question box, and we will address as many as possible at the end of the presentation. So without further ado, I present your speakers, Jennifer Papapanagiotou and Heidi Kocher.
Thanks, Gio. This is Jennifer Papapanagiotou. Thanks, everybody, for joining us today. As Gio mentioned, Heidi and I are partners here at Lyles Parker, and we both do quite a bit of transactional work for home health and hospice clients, both on the buying side and the selling side. So we wanted to share some of our experience in this area. Let's go to the first slide, please. So just as a rough outline, we're going to talk a little bit about mergers and acquisition trends, a little bit about the basics of a transaction. We'll cover some of the relevant health laws that apply to transactions, the basic important steps and documents in the process of buying and selling, common post-closing issues, and then some special issues that come up in home health and hospice that are unique to this particular area. Let's go to the next slide, please. All right, so the landscape for transactions for home health and hospice has matured quite a bit since COVID. That being said, we are still seeing a ton of pandemic-related enforcement and just increased auditing in general of specifically hospice. You know, home health kind of had its day in the 2010s and up through the early 2020 timeframe. But hospice has definitely become a much bigger focus of federal enforcement and state enforcement efforts since, I'd say, in the last 3 to 4 years. The enforcement folks, especially the Department of Justice, are still looking at PPP loans, provider relief funds, SBA disaster loans, auditing people who participated in those programs. And we're still seeing those scrutinized by buyers when we have transactions. They'll look at what programs they participated in. Did they utilize the funds appropriately for each program? Did they do required reporting, things like that? The other, as I mentioned, hospices have really been the target of a lot of enforcement activity and a lot of scrutiny in general. And there's a couple of things that happened in the last several years. One of them was that CMS extended what we had known for many years as the 36-month rule for home health. It was extended to hospices effective January 1 of 2024. And what that rule basically means, if you've not heard of it before, is that you cannot have a change in majority ownership of either a home health or a hospice agency more often than every 36 months. This really can drive both the timeline and the structure of a transaction if it is an issue. And it's something when I'm helping a client on either side, we look at this issue right off the bat. We want to know if we're going to have to address a recent change in majority ownership for a seller from the very beginning. It can change the dynamics of the deal. It can change the structure of the deal. And a change in majority ownership, we'll talk a little bit more about this later, but it essentially means either you have a 100% asset sale or an asset sale that involves a Medicare provider agreement, where you have a different legal owner with a different tax ID number after the transaction closes, or you have a change in a majority either shareholder or in an LLC member of the entity that's certified. So you may have the same legal entity owning the business before and after the transaction happens, but it has a new majority owner. Both of those have sort of really been fully implemented at this point. They are sources of concern in a transaction. It's something you have to plan around. The other thing that was introduced, and it's probably been a good solid 18 months plus since this was put into place, was what we call the period of enhanced oversight. This applies specifically to hospices that have asset sales or 100% changes in equity owners in Arizona, California, Nevada, Texas, and they recently added Georgia and Ohio. Obviously, Texas, and our audience here primarily focused on Texas. The Medicare Administrative Contractor oversees this process. It's triggered as soon as a buyer files their Medicare update application after a transaction happens. So if you have what we call a true asset sale, which is considered a change of ownership for Medicare, or you have a 100% change in equity owners, that will trigger Palmetto to do a small claim audit immediately. And we'll talk more about this later. It's been a considerable source of distress for buyers, and I can tell you a little bit more about that later. The other thing we're seeing is back 10, 15 years ago, a lot of home health and hospice deals were very much driven by how many patients do you have? And that has largely been replaced with other financial metrics. Buyers are much more interested these days. It depends on the situation, but what's your EBITDA? What are your earnings before interest, taxes, depreciation? What's your payer mix? Have you diversified your risk? If you were to lose a contract or a payer source, what will be left to that buyer? The analyses are becoming much more sophisticated, and it's driven the market. We've seen the multiples based on EBITDA go up and down. They were incredibly high during COVID. They came back down when the credit crunch hit after COVID and interest rates went up. And they are now coming back kind of more stable, I would say, to where they were kind of before the pandemic hit. So it's been an interesting ride over the last 10 years. Let's go to the next slide. So just basic things to keep in mind if you're considering a transaction on either side, whether you're a seller or a buyer. First and foremost, prepare yourself mentally for this process to take some time. Because of the sort of restrictive regulatory environment that healthcare operates in, there are a lot of things that drive the timeline. They're ultimately kind of outside the control of the buyer and seller. Required filings with licensing, required filings with the state of Texas, Medicaid contracting people. All of those can complicate and drive the timeline for a transaction. Diligence in and of itself can take time. People often ask me at the beginning, how long is this process going to take? And a good rule of thumb is plan for 6 months from the time you decide to sell it until you close it. It can be longer if it's a complicated transaction, or if you're a very large agency, if there are issues that come up. It can be faster. It very much depends on the parties on each side of the deal and the structure of the transaction. Also, because of increased costs and the complexity and enforcement risk, we saw and we're still seeing a lot of agencies that were probably started by individuals, a small group of people who decided to band together to start an agency in a local town or community. There's still a ton of consolidation going on with larger companies buying up these smaller companies, especially as owners mature and reach retirement age. That is still a very, very active market. We, as health lawyers, it sounds selfish when we say this, but I think it is absolutely essential, whether you're on the buying side or the seller side, that you have an attorney to represent your interests. Healthcare is subject to so many laws and regulations, and there are some really unique things that need to be addressed in healthcare deals. And I say a healthcare lawyer because we have an understanding of how your business works and what some of the key factors exist in those types of transactions that can drive structure. And we understand risks to healthcare businesses. We also understand how to structure around those risks. It can be challenging to have a general business attorney or someone who handled, your will, or who handled your friend's divorce, if they don't really understand healthcare and they don't really understand the transactional process for a healthcare business. You can find yourself, accidentally stumbling into regulatory problems that could have probably been avoided. So I think it's really important, if you are in this process, whether you're a buyer or a seller, that you try to find somebody with healthcare experience who can help you with that deal. I often see and highly recommend on both sides that you also, as part of your team, find a good accountant and or a tax advisor to help with structuring the transaction. Is the last thing you want to do is spend 25, 30 years building a business only to sell it and get beat up on the back end with tax liability that you might have been able to avoid. Often buyers want to restructure companies as part of the transaction process, or they want to buy your business in a particular way. And you really, as a seller, need to understand, what does that mean for me as a taxpayer? What am I going to be on the hook for? And is there a way to do this more efficiently for me? Because you don't know what to ask for if you don't have that counsel. So I really see a minimum of two people helping you, and a healthcare attorney or someone with healthcare experience in transactions, and a tax advisor, whether that's a CPA or a tax attorney. Let's go to the next slide. Again, just sort of some basic things to keep in the front of your mind. I would say with some level of confidence that I probably read twice as many letters of intent as deals that actually make it to closing every year. Lots of people enter into letters of intent, and we'll talk about those in a little bit, but never, for whatever reason, the deal never actually formulates. It can be for all sorts of reasons. And, we're not going to place blame in any of these. It's just a reality. Sometimes there's an issue that comes up that they just can't get on the same page between the parties, or a risk is there that nobody really understood or appreciated, or what they weren't aware of at the time they signed the letter of intent, and it changes the dynamics of the deal. It affects the pricing, something like that. It's one thing you just have to keep in mind in this entire process, and that is, up until you sign on the dotted line, ordinarily, if you've had good counsel, there's a way out. And there's always a pro and a con to that kind of decision, but I really encourage buyers and sellers to keep an open mind. It is important to commit to the process once you feel like you found the right buyer. But, I often tell people, if your gut feeling, if your gut's telling you something, you need to listen to it. Every deal is different, and based on the unique facts about a particular seller and a particular buyer. But in general, the process and the documents are going to be probably 7 to 80% the same from deal to deal, with about 20 to 30% being specially tailored for healthcare businesses, specifically home health and hospice agencies. We make very specific representations and warranties for healthcare businesses that a general business attorney, because they don't really understand all of the regulatory things that a hospice or home health agency is required to do, especially if they participate in Medicare and Medicaid, they may not be aware of those. They may not even know you need to include those. So that's where a healthcare lawyer can really help you customize what is, in many ways, a standard document that's used for all sorts of transactions. Let's go to the next slide. All right, so as a basic overview, important steps and documents in the transactional process, this is sort of the short list. We usually start with a letter of intent. And letters of intent, they're not a required step, but they are, in my experience, very useful for making sure the buyer and the seller are on the same page about the most important terms of a transaction. We'll talk about what goes on a letter of intent on a later slide. But once you get that stage, once you've kind of had a meeting of the minds about what the buyer is willing to pay and what the seller is willing to sell, we then generally move into the due diligence phase. That's where the buyer is going to collect a bunch of information about the seller in all areas of the business. The next step, once diligence is far enough along and the buyer feels comfortable moving forward, would be they'd have their attorney draft a purchase agreement. And that purchase agreement is going to cover these basic categories of terms. It's going to talk about the purchase price, how it's going to be paid, whether there are going to be any kind of escrow holdbacks. It'll talk about escrows and potentially earnouts or any kind of post-closing payments that might be made. It's going to include representations and warranties that are made by both parties, but the seller reps and warranties are really the meat and potatoes of how we level set risk in an agreement. These are disclosures made by the seller about the business, and transparency is important in that in drafting those. The next most important section are going to be the indemnifications, and this is how do we determine between the buyer and the seller who's going to be responsible for certain liabilities after closing. It's going to allocate certain liabilities to the seller and certain liabilities to the buyer, and that's really what the indemnification section does. There may be built into that indemnification certain exceptions and limitations, caps on liability or minimum liability amounts before a buyer, for example, can make a claim on a seller for indemnification. Those are usually a pretty important part of the agreement. And then it'll identify any ancillary closing documents that you're going to sign. There may be a restrictive covenant agreement. It may be an owner finance deal where you've got a promissory note that's referred to. All of those, maybe there's going to be a lease between a seller's real estate company and a buyer. There can be any number of ancillary documents that get drafted and signed as part of the larger transactional document. And then assuming you got all the way through that, eventually you're going to get to a closing where you transfer legal ownership of the business from the seller to the buyer in exchange, usually for money. So let's go to the next slide. All right. Before you draft and sign a letter of intent or a purchase agreement, again, I'm going to say it several times, talk about the structure of the deal, what your goals are, and have a healthcare attorney or someone experienced in transactions look at that letter of intent, and especially that purchase agreement if you're already at that stage. Federal and sometimes state laws can impact the terms and timing of a healthcare transaction, and the last thing you want to do is sign a purchase agreement and find out 2 weeks later that you did something that endangered the license of the agency or endangered the Medicare certification or keep. Your attorney can help outline limitations in the purchase price, talk to you about the financing aspects of it, notice periods, and other key terms. And I'll just give you one example. If a buyer is going to pay a seller over time, and that's discussed in the letter of intent or in the purchase agreement, there can be fraud and abuse laws that dictate the structure of that kind of arrangement. How long the period can be, how the payment is calculated, and the seller's role post-closing. Those are things that a general business attorney may not be aware of because, for example, the anti-kickback statute and the Stark law are so unique to the healthcare industry. Let's go to the next slide. So I'm just going to touch briefly on the two most important laws, probably the two most important we deal with in healthcare transactions. The first being the Stark Law. Stark Law is a federal civil statute that prohibits a physician from referring patients for designated health services to an entity with which that physician has a financial relationship. There's a lot of key terms in there. One of the most important ones is that this only involves referrals for designated health services, and all of you hospice owners out there can take a big step backwards and ignore my next 30 seconds of that conversation because hospice is not a designated health service. So we don't have to worry about the Stark Law when we're buying and selling hospice agencies. However, home health services are designated health services. And while it is unusual for the Stark Law to become an issue in the sale of a home health agency, it can in such situations where you may have a physician investor in that home health agency. It is pretty uncommon because there are so many restrictions on physician investment in home health. And the Stark Law essentially made it really difficult for a physician to be an owner unless they were never going to refer a patient to that agency. There's a couple of exceptions where people were able to do it. And I have seen home health agencies with physician owners, but they live in another state or they're somehow not ever going to be a referral source. But and it would only apply again, if a home health agency had a physician owner and that physician was ever going to refer a patient to the buyer home health agency after a deal. Stark is a strict, what we call a strict liability statute, meaning you have to comply with it or you violate it. There's no intent standard required for a violation of the Stark law. So I just, again, as an example, if a home health owner sells their home health agency and say they still own a hospice or another healthcare business that might generate referrals to the buyer entity, this is a situation where we might need to consider whether the Stark law is going to apply. Let's go to the next slide. There is an exception under the Stark law for isolated transactions, so that if we determine it does apply to a particular transaction, we would structure to comply with this Stark exception in order to protect the transaction under the from violating that particular law. It requires the total payment to be fixed in advance. That's the purchase price for the business. It can't take into account the volume or value of referrals. It has to be commercially reasonable, even if there was never another referral between buyer and seller. And there are some time limits on subsequent transactions between the parties. Again, it's rare that Stark applies in a home health or hospice deal, but I have had isolated situations where we've had to pay attention to it in the past. So it is something a healthcare attorney can help guide you through and give you some peace of mind, whether that's going to be an issue or not. Let's go to the next slide. The anti-kickback statute is typically more of a concern in healthcare transactions because it's just a much broader law in general. It is a criminal statute that says that you may not engage in the knowing and willful exchange of anything of value to induce or arrange for referrals payable by Medicare or Medicaid. And I'm paraphrasing, but as I said, it's a criminal statute, so it requires a certain intent to violate it. And if you were to violate the anti-kickback statute, it can carry significant penalties and even jail time. And then again, federal criminal statute. Transactions between parties who refer to each other can be subject to the anti-kickback statute. I'll give you an example of where this comes into play. If you have a buyer who is buying, let's say, a hospice agency, and they want to pay you some of the money now, but they want some of the purchase price to be contingent on how that agency performs after closing. And then let's say they're going to keep one of the owners who is a key business development person for the agency. They want to keep him as an employee after close. They want to offer him a deal. That is sort of the best example of a situation where you can have a potential anti-kickback statute issue in the structure of a transaction. And again, unless you have a healthcare attorney that's familiar with the anti-kickback statute and the scenarios where it can come into play, you may not realize that that scenario where there's some kind of post-closing payment, it's probably tied to financial performance, and you're going to have one of the seller parties come and join the buyer, and they're going to directly influence the success of the agency after closing, help drive revenue, and then be paid based on that success for some post-closing, measurement, some financial metric. That's exactly what the anti-kickback statute was intended to prohibit. And I've actually had deals where this has been an issue, and we've had to restructure what everybody, try to meet everybody's goals, but at the same time do it in a way that's compliant. And I will say, 99.99% of the time we can find a path where everybody's happy, but it's a real thing that happens. This isn't just, pie in the sky is never going to happen stuff. Let's go to the next slide. So there's not a direct exception or what we call safe harbor under the anti-kickback statute for the sale of a home health or hospice agency. There is a safe harbor, and safe harbors are regulatory regulations that describe business arrangements that the lovely people at the HHS Office of Inspector General have said, listen, if you structure your deal to fit exactly within these regulatory requirements, you will not violate the anti-kickback statute. There really isn't one for home health and hospice transactions, but there's one that's very similar, or that is in a similar area that's for sale of physician practices. And they've never extended the safe harbor to include other kinds of healthcare providers. It's always been restricted to physician practices. It protects transactions among practitioners and between practitioners and hospitals if you meet every element of it. So while it doesn't necessarily apply directly to home health and hospice, it can serve as a very useful set of guidelines that we can use in structuring a deal where compliance with anti-kickback statute is a concern. I want everybody to keep in mind, though, because the anti-kickback statute is ultimately a criminal statute that requires a certain intent in order to violate it. The OIG's made it very, very clear. Like, we've suggested these safe harbors, they're promulgated in regulations, and we've told you if you meet every element, you're not going to violate the law. On the flip side, if you don't fit exactly into the safe harbor, that doesn't mean that you violate the law. The government still has to prove that you had the intent to violate, to engage in conduct that violated the law. And the government's going to look at all the facts to determine intent. So the anti-kickback statute, in some ways, you have a little more wiggle room, a little more flexibility. And if you don't fit right within a safe harbor, your transaction or your business arrangement may still be okay. These scenarios are why you really need experienced healthcare counsel to help you understand, where do I sit on the risk spectrum? Is this deal compliant with anti-kickback? Is it, heading over a little bit more towards the red zone and we need to rethink it? Are there ways we can structure it that reduce the risk on both sides? That's really where your healthcare attorney can become very, very useful. Let's go to the next slide. Again, I just said if a deal doesn't fit in a safe harbor, you're going to want to have your attorney help you analyze that situation, perhaps put their analysis down in an advice letter to you. And oftentimes we advise parties to, hire an appraiser if there's some question about whether buyer's paying fair market value to seller. One of the ways we try to mitigate risk is to demonstrate that that buyer's paying fair market value for that business. That ties back into some of the safe harbor regulations that, again, even if they're not 100% applicable to your particular transaction, they are an excellent go-by and can really help defend that arrangement. Let's go to the next slide. So first document we often see in a transaction is a buyer drafting what we call a letter of intent that outlines key terms and sort of sets the stage for negotiations. Often there have been some conversations before that. Maybe the buyer and seller signed a confidentiality or non-disclosure agreement so they could exchange some basic information about the seller business with the buyer. The letter of intent will usually include purchase terms and sort of key terms of the deal. Most parts of a letter of intent are non-binding. They're really just to memorialize, I'd like to buy your business. Here's what I think the basic structure of that deal looks like, and here's what the price I'm probably willing to pay you. There are, however, usually a couple of key terms that are binding, and that's confidentiality and oftentimes exclusivity. So the buyer wants the seller to promise both sides want to promise, we're going to keep this communication we're having about this transaction confidential between us for a period of time, probably a long period of time. And seller, you're going to promise not to sell the business to anybody else, usually for 90, 120 days, while the buyer evaluates the business and puts together its transactional documents. It is important to have some end date for that exclusivity because you want to motivate everybody to get it to the finish line. So I tell folks, listen, I would prefer you let me read that letter of intent before you sign it, if for no other reason than it can be helpful if there's certain high-level terms that I know historically have been really important in getting everybody on the same page for a transaction. If they haven't been addressed in that letter, when the buyer sent it over, we can open those questions up. We can make sure, for example, maybe the letter didn't mention whether or not the buyer wants a restrictive covenant. They want the seller to promise not to compete with them going forward. Was that mentioned in the letter of intent? If, you get into a transaction and you haven't really had that conversation yet, it wasn't addressed early on, it can become a real area of concern for sellers. Same thing with financial terms. What is the basic structure going to look like? Are you going to pay the whole purchase price up front? Are you going to pay a percentage up front and a percentage in a note? Are you going to pay the full purchase price up front but hold back a percentage for indemnification liability? All of those end up being important terms. So I encourage my clients, it would be really great and probably help us avoid some problems later on if you let me read that before you sign it. Let's go to the next slide. Once you've got your letter of intent in place and it's bound everybody to confidentiality in a certain period of time where they're only going to deal exclusively with each other, usually the buyer then begins their more intensive part of due diligence. Before a letter of intent, usually sellers haven't shared more than basic financials and a few other facts about the business. The due diligence stage is where the buyer's going to dig deep and they're going to look at your business from top to bottom. And I tell sellers, especially if I have the privilege of having worked with them before or they engage with me early on in the sale process, I want to help them get ready for diligence. I want to help them organize the kinds of information buyers are typically going to ask for. Because the diligence process, you want it to move along at a pretty good pace. I work with a lot of business brokers and their mantra is time kills deals. So the better prepared a seller can be to participate in the due diligence process, the smoother things are going to go. The buyers are going to look at your contracts, both payer contracts and vendor contracts. They're going to look at your employees. They're going to look at your documentation of all of your employee background checks. They're going to look at how you paid them. They're going to look at your employment tax information. They're going to look at your employee benefits if you offer them. They're going to look at your insurance policies and your loss runs. They're going to do what we call lien and litigation searches to make sure there's no outstanding liens or no pending litigation. They're going to look at your healthcare regulatory compliance history, surveys. They're going to look at Medicare and Medicaid enrollment information. Are you in good standing? Have you had any issues? They're going to evaluate that 36-month rule thing we talked about earlier. Make sure you haven't had any changes in majority ownership in the previous 36 months. It is going to bring, it's going to cover anything and everything about your business because obviously the buyer wants to validate that they're paying money and getting what they expect for that money. And they're going to identify risk areas and potentially ask questions about that. And they're going to do a lot of problem solving about how to transition that business from your ownership to their ownership, depending on the structure of the deal. Like I said, they're going to look at financial statements, tax returns, your general business operations, office locations, licenses, certifications, personnel matters, and all other aspects of the business. Let's go to the next slide. For buyers especially, and I will say this is it's always been important, but it's even more important now in hospice in Texas. That buyer is going to look at your current patient census, and they're probably also going to want to look at the last several years of claims and records and do a mini claim audit. Because if a buyer takes assignment of your Medicare and Medicaid agreement, meaning they keep your PTN, they keep your Medicaid credentials, they're taking all the successor liability, all of the things that have happened before they take ownership, they're buying. They get that when they get the Medicare agreement. And they need to understand, has this business been run compliantly? Do I have audit risk? And if so, how am I going to allocate that audit risk? Am I going to, the typical structure in any transaction is that the seller's going to indemnify the buyer for pre-closing audit liability. So if somebody audits the agency, let's say Palmetto comes back and does a retrospective audit, or Clarent comes back and does a retrospective audit after closing that it looks at pre-closing time periods, the buyer wants to know the seller is gonna participate in that process and defend it and be financially responsible for it. The buyer needs to understand that risk, and in hospice it's become even more important with this period of enhanced oversight that I mentioned earlier. The reason being, often if you're buying a going concern, a business that's been running for a period of time, they're going to have existing clients on census when you buy it. When you file that post-closing application with Palmetto to update your ownership information, that's going to trigger a claim audit. And while that claim audit is going to look at patients you've had on service since closing, many of those patients will have been patients before the buyer bought the agency. So the buyer is kind of stuck with all of the seller's documentation of those earlier services. They're going to be relying on the original election of benefits. They're going to be relying on the original consents, certifications, all of that stuff. And I have seen so many examples where the buyer just never really did a deep dive on the seller's documentation to understand the quality of the census they were buying, and it's become a problem after closing when they do these audits for a period of enhanced oversight. The reason it's such a big concern is it's not just a financial risk. Agencies, buyers who flunk period of enhanced oversight reviews get revoked. They lose their Medicare credentials. So it is a big deal. And I've been working with people on both sides, sellers and buyers, in states where this is an issue, and it just requires a lot of scrutiny to make sure everybody's comfortable. But the mini claim audit is intended to sort of identify weaknesses in the medical records and other supporting documentation and see if there are audit risks or if there are things that the buyer might like the seller to address before closing. Really big issues can reduce purchase price, or they can increase what we call holdback escrows, and in some instances, they can even kill a deal. It really depends, but it's just something sellers need to be prepared for. Their documentation needs to be in really good shape. You want to be doing, your own analysis of your compliance. And if you've been through TPE or you've been through another audit and you've done well, it's great to have that kind of information available for buyers to look at. Let's go to the next slide. I'm going to wrap up my portion just talking a little bit about the most important document in any deal. That's the purchase agreement. This is the definitive agreement for any transaction. And it's the binding document on all the parties that sets out the price, risk allocations, and all the other material provisions of a deal. It's going to serve as the basis for all legal rights regarding the closing, payments, penalties, and liability exposure after the transaction has occurred. So it needs to be negotiated and reviewed very, very carefully. Hopefully, you've taken our advice and you've engaged a healthcare attorney to help you with that. It's important that that document fully reflect the full and final intentions of the parties, because there are legal rules that essentially say that document's going to control everything after closing. If you didn't put it in that document, it's going to be really difficult to enforce. I told them we would do this, or I promised them this when we talked before we signed it. If it didn't make it into the purchase agreement, it's going to be really hard to enforce that promise later on. With that, I'm going to turn this over to Heidi and let her take us home.
Thanks, Jennifer. Appreciate it. So we're going to do now a little bit of a deeper dive into these various kinds of documents and what you need to have in the documents. So as Jennifer said, the purchase agreement is one of the key, if not the key document for the sale. And what this is going to do is it's going to identify what kind of transaction you have. We have three kinds of general transactions, and most of them will be either an asset sale or an equity sale. Occasionally, we have a merger where two companies come together to form an entirely new entity, or one company merges into the other. But probably 90 or 95% of our transactions are going to be either asset sales or equity sales. So an asset sale is where the buyer is acquiring certain identified assets, properties, and perhaps liabilities of the seller, but not the seller's equity. So in a general context, think of, oh, we're going to be buying Vehicles, we're going to be buying accounts receivable, that kind of thing. If you have an asset sale, there is a new owner of those assets after closing, and there will be a new EIN for those assets, which is going to be, of course, the purchasing entity. In an equity sale, the buyer is buying all of the seller's ownership or interest. So if you have a stock corporation, you're buying the stock. If it's an LLC, you're buying the membership interest. In an equity sale, the buyer is buying, again, the entire business, lock, stock, and barrel, all liabilities. So the entity then has the same name after closing and the same EIN. Again, it is just the ownership behind it after closing. Note that you're going to have to file an 855 for the equity sale. You might not have to file one for an asset sale, depending on exactly how you structure the transaction. Next slide, please. So we've got some unique issues here, again, in healthcare transactions. And as Jennifer said, this is not to advertise for us, but you really need healthcare attorneys that understand this. In an asset sale, we have some particular issues because home health and hospice agencies have typically few hard assets, things like, tables, chairs, cars. Most of your assets are either intangible, like bank accounts and accounts receivable, and in fact, most of the value is going to be in goodwill. In an asset sale, the buyer can and often does take assignment of the Medicare and Medicaid billing numbers, but will not take other liabilities. This is particularly common where the seller has a lot of non-healthcare debts. The asset sale is common where the buyer doesn't want the Medicare, Medicaid numbers, or the buyer is particularly risk averse. And again, the way it looks is really going to depend on the particular transaction. In a stock and membership interest sale, the legal entity that owns the hospice or the home health agency doesn't change. So it's still going to be ABC Hospice. But the shareholders or members behind the entity do change. In this particular situation, because you are purchasing just the membership or ownership interest, the buyer is going to accept assignment of the Medicare, Medicaid provider agreements, along with all of your other contract, tax, and any other liabilities. So for example, an asset sale would also be where there is a concern about potential audit risk on down the line. In a stock or membership sale, the buyer is going to be totally responsible for any audits coming on down the line, unless there are some provisions made in the purchase agreement. And in a merger, again, a successor liability for all of those things is going to depend on the structure of the transaction itself. Next slide, please. So when we have a purchase, we look at the price, obviously, and there's a number of ways that you can structure the price. Obviously, the sellers would like to get 100% of the purchase price at closing, and the buyers would like to pay as little as possible. Typically, what we see is that there is some kind of holdback in a transaction, and they can range anywhere from a couple of percent to 25 or even a third of the purchase price, depending on the risks associated with the business. And again, that's going to come out during the due diligence phase. Holdback periods can range from 6 to 36 months, again, depending on the kind of risks. And if you're going to have a holdback, you want to have a formal escrow account and agreement. This is to protect the seller. And what happens is an escrow agreement basically says the money that is owed is put into a separate account, an escrow account, and the escrow holder, who is a neutral third party, must release the held back funds upon the satisfaction of certain conditions. So essentially what it does is it requires the seller to place that money in a separate account, and the buyer has assurances that the seller is not going to welch on the debt owed. at a future point. Now, some sellers are willing to owner finance and let the buyer pay a down payment and then have structured payments over time subject to a secured promissory note. Again, kind of all depends on the circumstances of the agency and where the buyer and the seller are in terms of what they want to do and how they want to move forward. We will say that purchase price adjustments at closing are common. So for example, the purchase price, some of the purchase price may be used to pay the debts of the seller, may be used to pay the transaction costs of the seller, or provide working capital for the buyer. So these are all things that can affect how much money a seller is going to get out of a transaction at closing. Next step, please. Next slide, please. Some of the most important things in a purchase agreement are what we call representations and warranties, or we abbreviate it to reps and warranties. And these are made by both the buyers and the sellers, and they are legal confirmations that certain statements or conditions are true. For example, you are licensed to do business. For example, you have a valid and active Medicare certification. So that's an example of a rep and a warranty. You may have disclosure schedules attached to a purchase agreement, and they may identify specific exceptions or facts relating to your reps and warranties. Note that if you have a material inaccuracy in a rep and warranty, it can be grounds for the buyer to sue or to seek indemnification after the transaction. So we actually pay a lot of attention to reps and warranties. So again, as I said, some common examples are a statement that the financial reports are accurate, complete, that there's no litigation or audits pending, and that the business has complied with all applicable laws. Next slide, please. We have some unique reps and warranties in healthcare. And again, this is not something a general attorney may necessarily be aware of. But you'll want to have reps and warranties that you have all licenses, certifications, and contracts necessary to operate, and they're current and in good standing. The seller is enrolled in Medicare or Medicaid as appropriate, and those enrollments are active. That the seller's owners are not subject to any disciplinary or corrective actions or appeals. Here's a big one. The seller has been conducting exclusion screening, has records of it, and has no employees, contractors, vendors, or owners who are excluded. If you're not doing exclusion screening, this is something that can come back to bite you much further on down the line. And again, depending on how you structure the transaction, can be quite an issue in the future. Some more reps and warranties are that there are no claims, enforcements, or other actions, administrative proceedings, audits, or investigations pending against the seller or the seller's owners. And in home health and hospice deals, we have to make a rep and warranty addressing the 36-month rule, basically stating that there has been no change in majority ownership in the last 36 months. Next slide, please. Indemnification, as Jennifer mentioned, is very important. This protects both the seller and the buyer. In terms of protecting the buyer, it's that the seller agrees to compensate and hold harmless the buyer for any problems that arise in the business because of the seller's actions, breaches of reps and warranties, or claims by third parties that relate to pre-sale periods. We often don't see indemnification really so much to protect the seller, but on occasion it does arise. And again, very often we see escrows that hold a portion of the purchase price to cover the indemnification obligations or the potential indemnification obligations for a specified period of time. Next slide, please. Qualifications and exceptions. Qualifications and exceptions are things that may limit a party's liability. Jennifer mentioned that you may have a minimum amount of liability before the buyer can turn to the seller for indemnification, or there may be a cap, or there may be a disclaimer or revision of certain reps or warranties. one of the things that we want to be looking at is whether or not these things that may happen constitute a material change in the business. And again, these are things that can be written into your qualifications and exceptions. Typically, we can also put time limits on indemnification. This is important because you don't want to have an indefinite indemnification liability. And so some of the things that we look at are what are called statutes of limitations on healthcare laws. Statutes or limitations are how far back the government or somebody else can go back in time to look at events that occurred in the past and apportion liability based on that. Qualifications and exceptions are extremely negotiable since they are extremely fact-specific, again, depending on the scope of a particular transaction. Next slide, please. So once you have negotiated and signed the purchase agreement, the next step is closing. Closing sometimes occurs on the same day the purchase agreement is signed, or it may occur later, particularly if third-party consents are needed or if you have to get financing arranged. So the purchase agreement in that day occasion may say closing will occur at, let's say, 30 days after signature, and then you have to do things in the meantime and you can close later. Now, if you don't sign the purchase agreement on the same day as closing, then you will have a conditions to closing provision, and this is a key section. Again, failing to meet a material condition is grounds to not close. So for example, the buyer can't qualify for a license. You can't get a consent to transference of a contract, or financing falls through. These are all things that can be negotiated and need to be considered in the process of negotiating the purchase agreement. Next slide, please. So at closing, the parties, if they have not yet, will review all the relevant documents, agree to any necessary additions or revisions, and officially transfer ownership of assets or equity interests in the business. And again, those are some of the additional documents that we draft. And then they transfer the purchase funds and or deposit escrow funds with the escrow agent. So closing is a very important transaction. Sometimes it's almost anticlimactic because you've done so much of the work up front, and at the end of the day, you're just closing and transferring money. But again, it's going to vary and depend on the particular transaction. Next slide, please. Many people think that when you close, that's it. Well, this is almost never the case with healthcare businesses in particular. For example, many buyers may want a transition period where the seller or the seller's managing employees stay around for some period of time to assist in retention of employees and patients and referral sources. They may need training on particular aspects, such as your EMR. There's a variety of reasons why the seller might be wanted to stick around for some time. And so in this circumstance, the goal of the seller is to minimize its exposure to liability from claims made by the buyer. So again, you don't want the buyer to be able to say, oh, we're not going to pay you some kind of earn-out because you didn't help us, and now the business tanked in the meantime after the closing. On the flip side, the buyer is now running the business with all of its challenges, and if it comes across issues that the seller should have disclosed or for which the seller was responsible, the buyer may seek indemnification. We have both had situations where an audit appears to be closed, and after closing, you get an overpayment demand letter saying that dates of service prior to the closing were determined to be not medically necessary or improper, and seeking refunds of the allegedly overpaid amounts. So those are obviously circumstances that you would need to include in any kind of indemnification and address after closing. Again, some transactions have deferred payments, and there's many, many different kinds of deferred payments. Often it's a promissory note. Sometimes it's an earn-out. It really sort of depends. And so here the buyer and the seller are going to rely on each other to comply with all of these deferred payment obligations and reporting. So it's pretty rare that buyers and sellers walk away from closing kind of doing or wiping their hands and it's all done. It's rare. Next slide, please. So also, many deals include restrictive covenants. So some will protect the buyer, such as non-compete and non-solicit covenants, and others are going to protect the sellers or their reputation. So there may be covenants addressing the business's employees, terminations, pay, severance. There's a whole host of different things. So again, another reason why the relationship between the buyer and the seller continues after closing. And all of these topics are common subjects of dispute between the parties. And for that reason, you really want to have these covenants reviewed by an attorney. There are specifics, for example, on non-competition agreements. They are typically limited in their scope by geography, time, or practice area, meaning line of business. There's a lot going on there with that. So again, the relationship usually does not end at closing, and there is definitely the potential for afterwards to have some issues between the parties. Next slide, please. So some of the things that we also see is you may have post-closing purchase price adjustments based on updated values of the business or sharing of accounts receivable. So for example, we all know that there are delays in claims and reimbursements, but for dates of service that are prior to closing, the payment is going to come in after closing. So perhaps there is an agreement that the seller will collect those reimbursements and then turn them over. The buyer, let me rephrase, the buyer will collect those reimbursements and then turn them over to the seller. So the purchase agreement is really going to need to define how accounts receivable are going to be split, and that needs to be very specific. This is actually a huge source of issue and contention and dispute after the fact if it's not considered in advance and handled properly in the language of the purchase agreement. Buyers also often want purchase price adjustments to discourage the sellers from letting the business fall apart during the transaction negotiations or while waiting to close. Again, so if you have a condition to closing, 30 or 60 days, you want to make sure that the seller essentially doesn't walk away and the buyer is in fact getting what they are paying for. One thing to remember is to file your Medicare or Medicaid change of information or change of ownership applications timely. You have 30 days after closing to do this. Note that this is different from getting your consents on, for example, your insurance contracts to transfer them. So you have to consider all of that in process. Next slide, please. So some special issues for home health and hospice. Jennifer already mentioned the 36-month rule. Sometimes you want to go ahead and have a sale, but you can't close because you're perhaps within 6 months, you're at 30 months. So sometimes what we have here is that the buyer will enter into a management agreement for the 6 months while we wait for the 36-month limit to run out, and this becomes part of the transaction. As Jennifer mentioned, hospices with asset sale or 100% equity sale are now subject to enhanced oversight, and this can include prepayment review from anywhere from 30 days to a year here in Texas. You need to review the payer contract assignment and notice provisions carefully. It is not uncommon that a payer contract either terminates upon a sale or requires consent of the payer for that contract to transfer. And often there are 30-day, if not longer, notice provisions. So you need to be making those notifications on a timely basis. You also need to consider what staff you will retain. Remember, your staff are going to be key to retaining patients. Patients have a relationship with the staff who's providing services, not with ABC Hospice or ABC Home Health. So remember thinking through that. Don't forget to notify your accrediting body. Again, if you have accreditation, that is really important to maintaining all of your other statuses, and it's going to be something you've made a rep and warranty about most likely. Buyers will want to review the seller's compliance plans and procedures and any audits, internal and external. And I will add to that, as part of the compliance plan, make sure you understand where they are in terms of HIPAA compliance. We are starting to see more and more issues with HIPAA compliance and breaches. You want to make sure you understand what that is and what needs to be fixed and updated and addressed afterwards. You may want to consider cost-saving strategies that could be realized in the transaction. So if you have one agency buying another, you may be able to remove redundancies. You may be able to streamline technical and administrative sessions. You may have improved or increased outreach and marketing efforts. So everybody's going to need to evaluate if this is a good transaction for them. Next slide, please. And I promise we're almost done here. So one special issue that we have is, again, is the PPEO. This is now active for hospice initial enrollments, CHOWs, and 100% change of shareholders and members in Texas. So what happens here is that the MAC will review a sample of claims after any of these events. We have seen really wide variability in how the MACs are implementing this. And unfortunately, there's no public detailed policy direction on how the MACs are to implement PPEO. What we have seen in Palmetto is that you review 10 claims, and if you fail, they will review an additional 10 claims. This is very similar to TPE. Repeated failure can result in referral to the UPIC or revocation. And recently, and I can attest to this, what we are seeing is revocations after one round if the error rate is very high. And I have a case where a brand new hospice, they were just getting started. They had 2 patients. They had letters on the claims. The MAC determined that the one patient did not meet medical necessity, and now you're looking at a 50% error rate, and the hospice had their number revoked for 10 years. So pretty significant outcomes. You really want to make sure you understand what you're doing with those claims and be sure to appeal them. Very important to appeal all of those claims denials. NGS, the MAC for California and Arizona, is also aggressive. For example, we have a situation where they requested all the claims for 1 month for a large hospice in Arizona, and then held 100% of the payments until the claims review was completed. We have another example where we have a small sample of 8 claims for a hospice in California, found an 80% error rate, and again, they revoked that hospice's Medicare billing credentials as well. So, if you are a buyer, you need to be extremely thorough and conservative in your due diligence and with your admissions criteria during the period after closing. All patients, and I cannot emphasize this enough, all patients should clearly meet Medicare admissions criteria, and all documentation needs to be 100% technically accurate and complete. There is no room for error with this PPEO, unfortunately. Next slide, please. Okay, so as Jennifer and I have discussed, these transactions are a complex and often lengthy process, but they are very rewarding if you've done your homework and your research up front. If you are buying or selling, you always want to make sure that the business itself continues to operate in its customary manner while negotiations are pending. You want to be aware of potential fraud and abuse issues, including Stark and anti-kickback statute. You do want to engage experienced professionals to handle the transaction, including valuations and negotiations, and those can be lawyers, appraisers, or accountants. Cannot emphasize this enough. And then finally, be aware of all of the long-term risk allocation issues that can go on long after closing. Next slide, please. That's our presentation. Do we have any questions, Gio?
Yeah, I believe we have a few. Okay. So the first question is, what EBITDA multiples are you seeing for the home health companies and for the hospice companies?
This is Jennifer.
Go ahead,
I
Jennifer.
don't know
Yeah.
what Heidi's experience has been, but it's so fact specific. I mean, I've seen as low as 2.5 or 3 if it's a bad payer mix, or the EBITDA isn't particularly healthy. Maybe it's got a really small census. But I've also seen 8X on a really healthy agency in a great market with a great payer mix, good rates, and a really clean compliance history. So I'd love to be able to tell folks there's some magic number out there, but it is so entirely fact specific that it's really hard to say, oh, yeah, everybody's getting 4 or 5X. It just doesn't work that way, unfortunately. Heidi?
Yeah, the same. I've seen some really low EBITDAs. I've seen some high EBITDAs. I would say if somebody's promising you 15 or 20 times EBITDA, run for the hills. There's probably something else going on there. That's not a realistic valuation.
Okay. The other question is, other than the closing price, what other transactions cost are there and cost amounts?
This is Jennifer. I mean, the normal ordinary things we see addressed at closing out of purchase price would be payment of any liabilities that the seller needs to get rid of as part of the transaction. That could be paying off a line of credit. It could be paying off, for example, a small business loan that they may have taken out when they started the business. It could be a lien related to a piece of litigation or a settlement in litigation that needed to get paid off. Those are often negotiated and they're just deducted, and the buyer will pay those creditors directly. We also often see transaction expenses paid out of closing funds. That might be a commission to a broker who represented the seller, or it could be legal fees to the seller's counsel to pay them out of closing funds. Other than that, it really depends on the structure of the transaction. We kind of referred to working capital and accounts receivable, and it's very deal specific. Often buyers want to buy the seller's accounts receivable to provide a source of working capital to run the business after closing. And in that situation, often we set a target for what the accounts receivable would be at closing. And if we're a little bit over or a little bit low, there might be an adjustment to the purchase price to make up for that at closing. So those are the primary expenses that you see kind of deducted from closing funds. That's all very negotiable between the buyer and seller.
I will add that the other things that I have seen is if there is any kind of deposit for the leased space, if you're renting space, or utilities, those may or may not come out of the closing price as well.
Okay. The next one is, what problems do acquiring companies encounter after acquiring home health and hospice companies?
I mean, I know the nightmare is you took you get a letter from Clarent or you get a letter from Palmetto some point after the transaction saying, hey, we want to review a bunch of claims. Please send us records for these 30 patients, and it's going to cover time periods before and after closing. In situations like that, the buyer and seller end up working often together to respond to situations like that. I mean, I've seen situations where a malpractice suit got filed, or a personal injury lawsuit got filed after closing that related to something that happened before closing. And there's, purchase agreements, provisions are drafted specifically to address situations like that and to sort of allocate the risk of that to the right party. Heidi, what other things have you seen?
Yeah, most commonly I see audits that refer to episodes of care or dates of service prior to closing. And again, depending on what the situation is, those can go back quite some time. I mean, I've seen one that went back 6 years, dates of service, and the closing had happened a couple months prior. So essentially they were looking for 5.5 years worth of records from the seller. And so the buyer had to get with the seller. So yeah, that's the big thing there.
Yeah, I will say the other one I've seen it with some regularity are tax related things that may come up after closing. Yeah. And if buyer didn't really do their tax diligence well, it can kind of blindside them. That can be related to anything from like minimum essential health coverage issues, where maybe a seller didn't fully comply with that requirement and they were supposed to, and the IRS is imposing some kind of penalty that really, the buyer should have been aware of. That might be a risk. Or just any kind of tax liability, especially in an equity deal, because the buyer owns the business at that point. They own the entity and its EIN number and all its potential risks. So I've seen situations where that's popped up, and there's a process laid out in the transactional document that addresses that and how to handle that situation.
Okay. The next one is, why did you mention that Stark laws don't apply to hospice agencies?
The Stark law only applies to certain kinds of services, and it's defined in the statute and in the implementing regulations. And designated health services do not include hospice services. So Stark doesn't apply to hospice.
Okay. In asset sales, is it possible to buy the clients/patients only of a home care, home health, or hospice agency without triggering Stark or anti-kickback laws?
Well, I don't know about you, Heidi, but we don't buy and sell people.
Yeah, I was just going to say we never buy and sell patients.
Yeah, that isn't really the way you articulate the assets that are being sold or purchased in a transaction. We generally refer to certain tangible items, so real things, intangible items like contracts or rights to receive payment like accounts receivable. And then we talk about goodwill, which is, all the things about a business that don't fit neatly into another asset class. And that's the relationships that the business has with its referral sources. It's the relationships it has with its patients. And there are certainly situations where I've had a buyer only want to essentially absorb the goodwill associated with the seller. And there's some hoops to jump through to do that if they're not going to sort of purchase the license and the Medicare number. So it's a little different sort of transaction, but it's something Heidi and I have both certainly handled.
Yeah, and let me just add that if you're talking about buying or selling patients, you are getting dangerously close to buying or selling referrals, which of course are a violation of the anti-kickback statute.
Next question, this is the last question. What are common broker fees?
I've seen it a little bit of anything and everything, and every broker has their own structure, but I would say it's not uncommon to see them in the 2 to 5% of purchase price range.
Yeah, I was going to say it also all depends on how much work the broker is doing. I have seen a situation where a broker charged 10% for doing very little work. And, on behalf of my client, I objected to that. On the other hand, sometimes the broker has to do an awful lot of work. So it's going to be variable. Part of it is, again, the circumstances of the buyer and the seller and how much work the broker has to do.
Yeah, and I would
To
say
help
on
move
top
the
of that,
transaction along.
there are brokers out there who simply list your business and do nothing once you've signed
Yep.
a letter of intent to facilitate the deal otherwise. You really need to look out for that. You need to understand what you're getting when you sign up with a broker and carefully consider, and I suggest shop around for, what kind of support you want. I've worked with all different kinds of brokers, and, I've seen tiered structures where the broker makes a certain percentage if the price is this, and if it's over that, their percentage actually declines as the price goes up. It really depends on the seller and how much support they think they're going to want. I honestly think if you want access to a good qualified group of potential buyers, you should be willing to pay for that. And you should be willing to pay another, an extra 1 or 2% if you're going to get access to better quality buyers and you're going to get better support through the transaction process. Heidi and I have worked with lots of different brokers over time. We're always happy to talk to people about our experiences.
And let me just add that Jennifer and I mentioned earlier about having people involved who understand healthcare. I've actually worked with business brokers that do not understand healthcare, and those are actually some of the most difficult transactions because the brokers don't understand why we are putting some of these provisions in purchase agreements. They don't understand the application of the Stark and anti-kickback law. They don't understand the 36-month rule. And then very, very quickly, sometimes even before closing, they have their hand out for their percentage. So you really need to, as Jennifer said, do your due diligence with any brokers.
There's one more question that just come in while you guys were talking. It says, if I'm interested in purchasing a home health agency or hospice emergency in my city, where should I usually go to find agencies available for sale?
There are certainly broker listings out there that you can look at. You can reach out to some of the big business brokers that Heidi and I have worked with. And I'm happy to correspond with the person asking the question by email. If you want to reach out to one of us, we can certainly give you some suggestions.
And if you're a TAHCH member, sometimes that gets posted on the member forums at TAHCH.
Okay, cool. So let me close out. So that concludes today's webinar. Thank you for joining us, and thank you to our speakers, Heidi and Jennifer. Everyone from today's webinar will receive a copy of the presentation tomorrow via email. And if you have any further questions about today's discussion or another healthcare law issue, please feel free to reach out to our speakers that you see above or in the PowerPoint slide, or directly to Lyles Parker. Have a good Wednesday and take care. Thank you, guys.
Thank you.
Bye-bye.
Bye.